95% of people will never build real wealth, and it has nothing to do with how much they earn. It's because they don't understand the 23 different ways money can actually work for them. Right now, your money is either growing, dying, or sitting completely still. And here's the uncomfortable truth. Most people have no idea which category they're in. They think their savings account is safe. They believe their retirement fund is enough. They assume their financial advisor has their best interests at heart. But I'm about to show you why all three of those assumptions could be costing you millions over your lifetime. I've spent the last 6 months analyzing every legitimate investment vehicle available to everyday people. Not just stocks and bonds. Not just real estate. Every single method the wealthy use to compound their money while they sleep. The average millionaire uses 7 different investment strategies simultaneously. The average person uses 1, maybe 2. That's not a coincidence. That's a system. And by the end of this video, you'll understand exactly how that system works, which investments match your risk tolerance, and which ones are quietly stealing your future without you even realizing it. Here's what makes this urgent. Inflation is running at roughly 3% annually. That means your money loses half its purchasing power every 23 years if you do nothing. Your savings account paying 0.5% interest? You're actually losing 2.5% per year in real value. Over a 40-year career, that's catastrophic. We're talking about the difference between retiring comfortably at 65 and working until you physically can't anymore. But here's what nobody tells you. Every investment type I'm about to explain has a specific purpose, a specific risk level, and a specific timeline. Use the wrong one at the wrong time, and you'll get crushed. Use the right combination at the right stage of your life, and you'll build generational wealth. I'm breaking this down into 8 categories, from the safest investments your grandmother would approve of, to the aggressive strategies that could 10x your money in 5 years. And I'm starting with the one investment almost everyone gets completely wrong. Let's start with the foundation, the investments that should make up your financial bedrock. These aren't sexy. They won't make you rich overnight, but they're non-negotiable if you want to build anything that lasts. First, the emergency fund. This isn't technically an investment, it's insurance against life punching you in the face. 6 months of expenses in a high-yield savings account. Right now, the best online banks are offering around 4 to 5% APY. That's not beating inflation long-term, but that's not the point. This money needs to be accessible within 24 hours when your car dies, when you lose your job, when your roof starts leaking. Chart 004 shows relieved expression. This is your financial airbag. Second, treasury bonds and CDs, certificates of deposit. These are government-backed or FDIC-insured investments that guarantee your principal. Current 6-month treasury bills are yielding around 5%. 1-year CDs from reputable banks are in the same range. These are perfect for money you'll need in 1 to 5 years. Down payment for a house? This is where it goes. Wedding fund? Right here. You're trading higher returns for absolute certainty. Chart 005 appears with charts showing guaranteed returns. Third, money market funds. These invest in ultra-safe, short-term debt instruments. They're liquid like a savings account, but typically yield slightly more. Think of them as your parking spot for cash you're about to deploy elsewhere. Chart 001 appears taking notes. Now here's what most people miss about these foundation investments. They're not designed to grow your wealth. They're designed to protect it while you build your offensive strategy. The wealthy use these for liquidity and capital preservation. The mistake is keeping too much here. If you're 30 years old with $100,000 sitting in savings accounts, you're not being safe. You're being financially reckless in the opposite direction because inflation is eating you alive. These foundation investments should represent 3 to 6 months of emergency money, plus any cash you'll need within the next 2 to 3 years. Everything else needs to be working harder. And that brings us to the real wealth-building engines, starting with the investment vehicle that's created more millionaires than any other in human history. The stock market. Over the past 100 years, the S&P 500 has averaged roughly 10% annual returns. That means money doubles approximately every 7 years. Invested properly, this is the single most powerful wealth-building tool available to ordinary people. But there's a catch, and it's a big one. Let me break down the 4 ways to invest in stocks, because this is where people either build fortunes or lose their shirts. Method 1. Index funds. This is buying the entire market through something like an S&P 500 index fund or a total stock market fund. You're not picking winners. You're betting on capitalism itself. Chart 002 appears with tablet showing upward trend. Warren Buffett recommends this for 90% of investors, and he's not wrong. Low fees, automatic diversification, historically proven returns. If you do nothing else, put consistent money here for 30 years and you'll retire wealthy. That's not an opinion, that's mathematics. Method 2. Individual stocks. This is where egos go to die. Picking individual companies requires research, discipline, and honest self-assessment that most people don't have. Chart 003 appears confidently. The data is brutal. Roughly 90% of active stock pickers underperform the index over 10 years. If you're going to do this, limit it to 10 to 20% of your portfolio, maximum. And understand you're gambling with that portion, even if you've done your homework. Method 3. Dividend stocks. These are established companies that pay you quarterly cash just for owning shares. Think Coca-Cola, Johnson & Johnson, Procter & Gamble. Chart 006 appears interested. You're trading explosive growth potential for steady, reliable income. This becomes more important as you age. A 30-year-old should prioritize growth. A 60-year-old should prioritize dividends. The wealthy build dividend portfolios that generate 6 figures annually in passive income. That's the goal. Method 4. Growth stocks. These are companies reinvesting every dollar into expansion instead of paying dividends. Think Amazon in 2005, Tesla in 2015, or whoever the next disruptor is. Higher risk, higher reward, longer timeline. Chart 001 shows excited but cautious expression. Here's the framework. Your stock allocation should be aggressive when you're young, conservative as you approach retirement. At 30, 80% stocks make sense. At 60, maybe 40%. And never, ever invest money in stocks that you'll need within 5 years. Markets crash. They always recover, but only if you can wait them out.
Now let's talk about the investment accounts that will save you hundreds of thousands in taxes over your lifetime. This is where the wealthy legally pay less than you do, and it's completely available to everyone. 401k and 403b plans. These are employer-sponsored retirement accounts. Here's the magic. You contribute pre-tax dollars, meaning you reduce your taxable income today. If you're in the 22% tax bracket and contribute $10,000, you just saved $2,200 on your tax bill this year. Your money grows tax-free until retirement. And here's the best part. Many employers match your contributions. That's free money. If your company matches 50% up to 6% of your salary, and you're not contributing at least 6%, you're literally leaving money on the table. Traditional IRA, individual retirement account. You can contribute up to $7,000 per year as of 2025, or $8,000 if you're over 50. Same tax benefits as a 401k. This is perfect if your employer doesn't offer retirement benefits, or if you want to save beyond your 401k limit. Roth IRA. This is the reverse play, and it's absolutely brilliant for younger investors. You pay taxes on the money now, but every dollar of growth is tax-free forever. Imagine contributing $6,000 per year from age 25 to 35, then never contributing again. At historical market returns, that $60,000 investment becomes over $1 million by age 65, and you pay zero taxes when you withdraw it. Zero. If you're young and in a low tax bracket, Roth is your secret weapon. Health Savings Account, HSA, the most tax-advantaged account in existence. Pre-tax contributions, tax-free growth, tax-free withdrawals for medical expenses. After age 65, you can withdraw for anything penalty-free, just paying regular income tax. It's a retirement account disguised as health insurance. Here's the strategy the wealthy use. Max out your 401k match first, that's free money. Then max out your Roth IRA for tax-free growth. Then max out your HSA if you're eligible. Then go back and max out the rest of your 401k. This sequence maximizes both tax savings and long-term growth. Follow this exact formula and you'll outpace 95% of investors. Now we're entering territory where returns can be explosive, but so can the risks. These are investments the wealthy use to diversify beyond traditional assets, and some of them are finally accessible to everyday investors. Cryptocurrency. Let me be blunt. This is speculation, not investment. Bitcoin, Ethereum, and thousands of altcoins are highly volatile, largely unregulated, and subject to manipulation. That said, Bitcoin has outperformed every traditional asset over the past decade. If you believe blockchain technology will reshape finance, allocating 2 to 5% of your portfolio isn't crazy. But only invest what you can afford to lose completely. This is not your retirement plan. Peer-to-peer lending. Platforms let you become the bank, lending money directly to borrowers and earning the interest. Returns typically range from 5 to 9%, higher than bonds, but with default risk. Diversification is critical here, spread small amounts across hundreds of loans. I view this as a bond alternative with slightly higher risk and higher returns. Commodities. Gold, silver, oil, agricultural products. These often move opposite to stocks, making them valuable for diversification. Gold particularly shines during economic uncertainty and inflation. But commodities produce no income, so you're purely betting on price appreciation. A 5 to 10% allocation can stabilize a portfolio, but this shouldn't be a core holding. Angel investing and startups. This is how the ultra-wealthy get ultra-wealthier, but it's also how they lose millions. Investing in early-stage companies means most will fail, but one winner can return 50 to 100 times your investment. Crowdfunding platforms have democratized access, but understand the stats. 90% of startups fail. Only invest money you're prepared to lose, and only if you have expertise in the industry you're backing. Collectibles and alternative assets. Art, wine, classic cars, sports memorabilia, even Pokemon cards. These markets are inefficient, illiquid, and require deep expertise. Unless this is your passion and you know the market intimately, stay away. The transaction costs and authentication risks make this a poor choice for most investors. Your own business. This is the ultimate investment. Build something that generates cash flow and you control every variable. The risk is concentrated, but so is the potential reward. More millionaires are created through business ownership than any other method.
Real estate has created more millionaires than any asset class except stocks, and it works completely differently. This is about leverage, tax advantages, and forcing appreciation. Let me break down your options. Primary residence. Your home isn't an investment in the traditional sense, but it's a forced savings account. Every mortgage payment builds equity. Over 30 years, you'll pay off a loan and own an asset worth substantially more than you paid, assuming you bought in a decent market. Plus, when you sell, up to $250,000 in gains are tax-free if you're single, $500,000 if married. That's a massive tax advantage most people don't appreciate. Rental properties. This is where real wealth gets built. You buy a property, rent it out, and ideally the tenant pays your mortgage while you build equity and enjoy appreciation. The magic is leverage. Put 20% down on a $300,000 property, and if it appreciates 5% per year, you're earning $15,000 on a $60,000 investment. That's a 25% return on your actual money. Plus rental income, plus tax deductions for depreciation, mortgage interest, repairs, property management. But let's be realistic. Being a landlord isn't passive. Toilets break at 2 in the morning. Tenants stop paying rent. Markets crash. You need reserves, patience, and a stomach for risk. If you're not handy and don't enjoy problem solving, hire property management and accept lower returns, or skip this entirely. REITs, real estate investment trusts. This is real estate for people who don't want tenants calling them. REITs are companies that own and operate income-producing real estate. You buy shares like stocks. They're required to distribute 90% of income as dividends, so you get steady cash flow without fixing broken dishwashers. Publicly traded REITs are liquid, diversified, and professionally managed. Returns historically average around 8 to 10% annually. How's hacking? This is the strategy that changed my perspective on real estate. Buy a multi-unit property, live in one unit, rent out the others. Your tenants pay your mortgage while you live for free or cheap. FHA loans let you do this with just 3.5% down. This is how young people with limited capital break into real estate investing. The framework: if you're buying a primary residence anyway, make it a smart financial decision. If you want real estate exposure without the hassle, buy REITs. If you're willing to work, rental properties can build generational wealth. Now here's where everything comes together. You don't need to use every investment I've covered. You need to build a strategy that matches your age, risk tolerance, timeline, and goals. Let me give you 3 frameworks. The age-based allocation. A common rule: subtract your age from 100, that's your stock percentage. At 30, 70% stocks, 30% bonds, and safer investments. At 60, 40% stocks, 60% stable income. This isn't perfect, but it's a solid starting point that automatically adjusts your risk as you approach retirement. The 3-bucket strategy. Bucket 1 is safety, emergency fund, money markets, short-term CDs, money you need in 0 to 3 years. Bucket 2 is growth, index funds, individual stocks, real estate. Money you won't touch for 5+ years. Bucket 3 is speculation, crypto, startups, aggressive growth plays. Money you can afford to lose. The ratio depends on your situation, but a common split is 20% safety, 60% growth, 20% speculation for someone in their 30s. The income-focused strategy. This is for people approaching retirement or seeking passive income. Heavy on dividend stocks, REITs, bonds, rental properties. The goal isn't maximum growth, it's reliable cash flow. Build a portfolio generating 4 to 5% annual yield, and you can live off the income without touching principal. This typically requires significant capital. Think $2 million generating $80,000 to $100,000 per year. Here's what most people get wrong. They chase returns without considering taxes, fees, or their own psychology. A portfolio returning 12% that you panic sell during a crash performs worse than a portfolio returning 8% that you hold through volatility. Behavior matters more than optimization. The wealthy use all of these investment types strategically. They have emergency funds, maxed retirement accounts, diversified stock holdings, real estate producing cash flow, and calculated speculative bets. They don't put all their money in one place, and they don't try to time the market. Your action plan. Start with foundation investments for safety. Max out tax-advantaged retirement accounts. Build a diversified stock portfolio through index funds. Only then, consider real estate and alternative investments based on your knowledge and risk tolerance. This sequence protects you while maximizing long-term growth. First, starting is more important than optimizing. A 25-year-old investing $200 monthly in a basic S&P 500 index fund will outperform a 35-year-old investing $500 monthly in a perfectly optimized portfolio. Time in the market beats timing the market every single time. Second, fees are wealth killers. A 1% annual fee difference on a $500,000 portfolio costs you over $200,000 over 30 years. Use low-cost index funds. Avoid actively managed funds with expense ratios above 0.2%. Question every financial advisor charging more than 1% of assets under management. Third, your income is your most valuable asset. Before obsessing over investment returns, focus on increasing what you earn. A $10,000 raise invested annually has more impact than picking the perfect stock. Invest in skills, certifications, networking, and career mobility. That's the highest ROI investment available. Fourth, avoid these common disasters. Never invest borrowed money in stocks or crypto. Never invest your emergency fund. Never trust guaranteed returns above market rates. That's a scam. Never invest in something you don't understand. And never ever panic sell during market crashes. The 2008 crash, the 2020 pandemic crash, every downturn recovered. The people who lost money were the ones who sold at the bottom. Here's your immediate action plan. Step 1. Establish a 3 to 6 month emergency fund in a high-yield savings account. Step 2. Contribute enough to your 401k to get the full employer match. Step 3. Open and fund a Roth IRA with a target date fund or S&P 500 index fund. Step 4. Increase retirement contributions annually until you're maxing out accounts. Step 5. Once retirement is handled, explore real estate, taxable brokerage accounts, or business investing. The difference between financial security and financial stress isn't intelligence, luck, or income. It's understanding how money works and taking consistent action over decades. You now know every major investment vehicle available. Most people will watch this video, feel motivated for 24 hours, then do nothing. Don't be most people. Start today, even if it's small, even if it's imperfect. 30 years from now, you'll thank yourself.